Hello everyone and welcome back to Element Portfolio for this week's market update. My name is Marcus and this is my portfolio and I'm recording this on the 12th of February. So we're going to continue in the same pattern as we usually do on these Sunday market updates. So we're going to start off with a weekly summary with past week's news and the market sentiment. We're going to go through a market update and then we're going to end with a summary and next week's news. So to start off, this week has been fairly calm or very calm compared to last week. So we can just walk it through real quick. So we got consumer confidence from the US preliminary, and it was 66.4 compared with 64.9 previously. We got the GDP growth rate from the UK, which came in at 0 compared to past number, which was 1.9, so that is not good, shows a real slowdown. And then we have the inflation in China. So CPI came in at 2.1 compared to 1.8 previously, and then we got the PPI at negative 0.8 versus negative 0.7, which was the previous number. So we can see here that inflation is not really a problem in China. So with that said, the market sentiment, like I said, it's been a relatively calm week, and it's kind of been the continuation from what happened the week before, which ended with a real cliffhanger with a very strong NFP number. So what this week has been focusing on is the Fed's reaction to this number. So what we could see, we got a speech from Powell. He was more less repeating what he said during the FOMC meeting, but he was also stating very clear that unless this NFP number is an anomaly, is rare, or if we're going to see more of this, then we're going to have to increase the rate hikes. And this has more or less been the narrative this week from both the Fed and the ECB, that the market has been pricing rates too low, and that they are still giving out these hawkish signals that they are going to increase rates if they need to. And now when we get stronger economic numbers, like the NFP numbers, then they have more room on the upside to do this. So what has been the reaction from this? Well, as expected, since we saw at the end of last week, so not this Friday, but the Friday before, we could see that rates started to spike up. This also made the indices to start going down, and we saw that the USD was getting stronger. And this is more or less what has continued to happen this week. We have seen an increase or a breakout in the rates. We have seen a cool off in the markets, and we have seen a stronger USD. So all of this is in line with what's been expected. If we look into the this week's fear versus greed, we can see that it's just slightly cooled off from 93% to 88%. And we can also see that the net long for the SP 500 has increased to 43.5, and I am skeptical about this. Like, I don't think we should read too much into this. Like, this is probably we're still in this bear market rally that is now starting to cool off due to what's happening with rates, but we were due for a cool off. So I think that what we're seeing now is just like a normal dip. And that is why also the S&P 500 net long is starting to slowly increase. It's because retail traders are buying the dip. But right now we don't really have that big of a catalyst that's going to take the market down to new lows. But we have a lot more to cool off the markets. So I think we're going to see more of a cool off or a dip, and then we can see how this is going to change. But more of that later. We can also see that the net long for the euro versus the dollar has increased, which means more are short the dollar. And this is counterintuitive since the dollar is getting stronger. So, and then finally just marginal change in the gold position. So it's getting smaller. We can see gold, what we're going to talk about later, is kind of consolidating at the moment from a strong start. If we continue with year to date or the indices, we can see here that year to date it is still strong. Here we can see that the average is 7.5 and Nasdaq is the one that's been leading up, so up about 13%. And it's important to keep in mind here that if we look at the 200 look back period, then Nasdaq is the clear loser at minus about 6%. So here it's important to see that this increase we've seen this year to date, has been kind of not a recoil, but it's been a revenge more or less from the indices that did poorly before, because this bear market rally has been more focused on tech sector, or the sectors that did poorly to 2022. And this is what we've been seeing for the whole October rally. So it's important here to zoom out and not only get stuck in this chart year to date, because it is important to see the whole picture. So to continue here, what do I think is the bigger picture, or the whole picture, or the bigger picture? It is to mention many times before, still believe that this is a bear market rally and we're heading for, or we already are, in a recession. And the markets are most likely going to print some new lows in 2023. However, I do not believe that this downturn has started yet and that this rally can continue until a big catalyst comes. But until then, we're going to see a similar pattern that we've seen from October. So it's going to go up and down slowly until this big catalyst comes. So now it's going to cool off, then it's going to gain momentum and strength and up and down. But the big catalyst, or not big catalyst, but something that's important to see how much it's going to continue to cool off or not, is going to come next week, and that is the CPI, or the inflation for the US. But more about that later. So to look at the indices, we can see here the same pattern as before, that we have had the rally since October, or for Nasdaq that started after New Year's or around there, and now it's been stretched on the upside, and now it's starting to cool off. Here we can see that most other indices are up in outlier country. Up here, most of them are at least outside their box. So it's a little bit different from the indices, but if we look at the year to date, most of them here are in for a cool down. I think that, like I said before, that we're going to see a cool off now, that slate is going to increase to new highs in this bear market rally, and that's going to continue until the catalyst comes. But we'll see how long this cool off takes. If I would get some kind of estimates, I would expect the cool off to come down below the mean, and the lower part of the box, so somewhere around here I would expect the mean, so around here as well, to be before starting to going up again. So I guess it depends on how the news are going to come in from CPI next week, and the market reaction to that, and the Fed reaction, of course. But I said that it's going to be a dip now. It might be a little wider, or not wider, but a little deeper than expected, but somewhere below the mean, at least for the 200 look back period, before going up again. If we continue with sectors, not too much to say here, just that now from the 200 look back we can see more of the sectors starting to pop out. Still during the year to date, most of the sectors are going up except for the defensive ones. And like I wrote here, we should expect this pattern to continue until the catalyst, and then we're going to see a shift in sectors where the defensive sectors are going to gain momentum and the ones that are strong now are going to go down. Continue with rates. This has been the main number this week, and we can see, as I talked about before, that we see some kind of breakout here. And this is fundamentally driven. So the rates are saying that we've been pricing rates too low. Then of course the market's gonna have to increase the price on rates. So we'll see what the Fed's action are gonna be, and I think this is here also the key event next week is the CPI. So that's gonna determine if the rates are going to continue up and how that is going to affect the rest of the markets. This is what it looks like if we zoom back 10 years. So it's still high. Or high, well, going back more to a normal stage, but we'll see how much the economy can endure. All right, let's look at foreign exchange. And what we can see here is that just like rates have been going up, the USD has also gained strength. So not too much right now, but we can see that there is some kind of shift in the different graphs. So for example here with, let's see if we can do, it's too small. So you see here we have, you can see the difference, like this is because the USD is getting stronger, same here, the USD is going up compared to the yen, and we have a similar pattern. Except for with the Swedish crown. Here we can see that the Swedish crown is getting stronger compared to the USD and especially compared to the euro as well. That's because the Swedish bank or Swedish central bank has now increased the rates to increase the value of the currency. And the common denominator for foreign exchange as well, and what we should look out for with the USD is, like I mentioned before, it's going to be what happened with rates, and I think that's going to be the key driver. There is going to be the CPI next week. And then finally commodities, not too much to add here, to be honest. Still see it at gold, what I think is a consolidation phase here, and I think it is charging to go and aim for newer highs. So it's going to have to be balancing to find the fair price in this range, and then it's before it can go up to new highs. But I think due to the inflation and everything that is going on, gold is a safe bet. So it is going to continue going in this range, maybe down and then up, down, up one more time, and then it's going to aim for new highs. And this is of course also determined by when the catalyst comes. But gold, I think that it is going to go up, not in the short term. In short term now it's going to continue to cool off a little bit, and then it's going to start going up again. So we'll see how long the range continues, but I still expect to see new highs in gold. Same here, like I mentioned last week, we can see oil is still, look here, kind of trying to find some form of bottom. We see natural gas is continuing to going down, and we see cotton and wheat as well. They are trying to stabilize some form of fair price after the speculation bubble that's happened after Russia attacked Ukraine. So now it's kind of consolidating here, and after that, when it finds a fair price, it can continue either to increase or decrease. I think though that especially wheat will increase during the spring, but we'll see how the outcome from the war has been. So I think how the harvest and everything's going to be planned for this spring, that is going to be the determinant factor. So that's all I had for this week, and like said, rates have been controlling the narrative, or rates together with the central banks. So if rates continue to go up, that's kind of how it's affecting all the other markets like indices starting to cool off, and then a stronger USD. And then next week's inflation with CPI for the US is going to be the key factor, how this will continue. And then commodities have just been continuing the same pattern as past week. So what we're going to see next week is for Tuesday, we're going to have CPI for the US. We're going to get preliminary GDP for the Euro area and unemployment of UK, and also preliminary GDP for Japan. And Wednesday, we're going to get US retail sales and CPI for the UK. And then on Friday, we get the leading indicators for the US and also retail sales for UK. So thank you so much for this week. So I'll see you next week, and take care.